By now, you may have known that my updated 4 fund portfolios have become one of the cleanest and most beginner-friendly ways to get real stock market exposure without drowning yourself in complexity. Think of it as a modern version of the index legend built decades ago. Because the original blueprint worked well in the 1980s and 1990s, and the markets we invest in today look almost completely different, new asset classes appeared, new industries led the trend, and completely new ways to capture growth were not under discussion at the time. So, the update had expired. But here is what happened. If you really want to push this portfolio into another gear, whether you're pursuing serious growth or having more profitable dividend checks, log into your account every month. You'll want to lock in a few specific areas, which is what I want to take you through today. My name is Marcus Reed. My community calls me Coach M. And I set up this channel to make investing feel less scary and more viable. Quick reminder that before we start, every investment is risky, so be sure to do your homework. What I share here is not financial advice, because I am not a licensed consultant. We start from the growth side, because these sectors are relatively volatile, hot, and have real volatility. But to a certain extent, the potential return is consistent with this risk. I think it is worth paying attention to. Number 1 is robotics and automation. And to be honest, 2026 will be a year waiting for breakthroughs in this field. Humanoid robots have crossed the line from science fiction demonstrations to actual factory floors. And the company has invested tens of billions of dollars in autonomous systems, warehouse robots, and industrial AI. Tesla, AB, and visual surgery anchor large cap stocks in trading, while smaller, pure games quietly increase revenue at a rate that most investors have not yet tracked. When you look at the numbers, the paper says so. Rising labor costs and aging populations in developed countries eventually force companies to automate. Like it or not, my personal view is that robotics has finally become a quietly outperforming industry, while others are debating chips. And the asymmetry of this space is the kind of model I'm looking for. The second factor is AI, but not the way most retail investors play AI. So put aside the obvious semiconductor name for the time being, because I want to talk about cooling, especially liquid cooling. Every AI data center under construction now runs into the same wall. Hot, because the GPU pulls absurd power, and traditional air cooling can't keep up. Vertiv, Vent Electric, and Schneider Electric are all directly at the bottleneck. And after years of being dismissed as boring industrial companies, they are now signing multi-year contracts directly linked to the superscalar construction project. Profit margins continue to expand, backlog continues to grow, and demand will not slow down in the short term. To be honest, I think cooling is one of the lowest valued AI transactions in the market because it is not flashy, just quietly printing money, which is the kind of environment I prefer. The third is encryption, which has changed dramatically in the past 2 years. Spot ETFs have become mainstream. Regulation has become clear, and corporate treasury bonds have begun to quietly accumulate digital assets. Just like short-term bonds before, Bitcoin is increasingly seen as a legitimate store of value. And Ethereum and the broader blockchain ecosystem drive the real activity of labeling and finance on the chain. After several brutal cycles, the market feels more mature than it was 3 years ago. But it stays early enough that the long-term runway still looks considerable. That is what it really means, because volatility is often the place to create real wealth for investors who can endure the journey. In turbulent markets, leaders tend to be people who really understand what they are buying, which is why I have recently spent more time on educational resources, including the research section on 21shares.com. Many thanks to 21 Shares for sponsoring today's video. 21 Shares is one of the world's largest providers of encrypted ETPs, giving investors access to digital assets through regulated exchange-traded products. Their entire focus boils down to bridging the gap between traditional finance and the crypto world, with a strong emphasis on transparency, security, and appropriate collateral. If you want to be sensitive to the realities of encryption and digital assets, sign up for their newsletter because you get direct access to clean market segments, product news, and trend analysis. You can also follow 21 Shares and 21 Shares Yes on social media, comment in time, and carry out compliance-friendly education. Their products may not be available in every region, and as always, this is not financial advice. Investing is risky, and you should talk to a licensed consultant before making a decision. Before we move on, I want to hammer out some important things. In my view, the sensible way to use each of the industries I cover comes down to seeing them as satellite positions around a larger core. The core handles heavy work, while satellites add spice. These high-risk sectors can definitely fly, and they may collapse soon, which means you don't want to cut most of your net worth overnight because you're a little too excited about the trend. Personally, about 75 to 80% of my portfolio is invested in ordinary broad market ETFs, and the remaining 20 to 25% is split between satellite ETFs in the sectors we report today, plus a small number of stocks. This structure allows me to sleep at night while still being exposed to trends I truly believe in. The fourth issue is nuclear weapons and uranium. And I can't believe how long it took this trade to sober people up, but here we are. AI data centers need electricity, cheap, clean, 24-hour power, a problem that solar and wind cannot completely solve because they are intermittent in nature. That is not true of nuclear power, which is why Keadu has signed direct power purchase agreements with nuclear operators in the past 2 years, which is why uranium prices are so volatile. Cameco Constellation Energy and BWX Technology are all in the middle of this shift, and small modular reactor companies have added another layer of noteworthy content, although these names have been traded earlier and speculated more. My personal view is that AI's power bottleneck ultimately determines the next decade, and nuclear power is the most credible long-term answer on the table. Of course, stocks have moved, but the runway in front of them still looks long. The fifth is the space sector, which keeps landing in my inbox. SpaceX itself remains private, but today the broader space economy is publicly traded through companies linked to satellites, launch services, defense contracts, and ground infrastructure. As launch costs continue to plummet, new industries have formed around satellite broadband, Earth observation, lunar logistics, orbit manufacturing, and other fields. Rocket Labs, Astis Spacemobile, and several defense prime do expose you to this trend. And a few thematic ETFs try to sum it up, although some ETFs' cost ratios should frankly be illegal. To be honest, I think space is in line with the general trend of the law for decades. But you have to be selective. Whenever SpaceX eventually goes public, it is quickly added to the main index, which means that automatic exposure will flow through your standard broad market fund anyway. So if you already have a whole market ETF, chasing a niche space fund may not be necessary now. The top 5 sectors focus on chasing the rise and taking advantage of the trend to locate the flow of smart funds. Number 6 is a completely different direction, designed for investors who only want passive returns to reach their accounts every month, rather than looking after their portfolios. Most people think you need to save $10,000 or $20,000 to live on dividends, and math is no longer correct. With the right mix of high-quality dividend ETFs, well-used covered buy-in funds, and smart withdrawals, you can realistically generate livable income from a much smaller base than people think. I personally believe that the dividend path is undervalued because it is not conducive to stimulating YouTube content. But the investors who quietly implement this strategy are often those who actually retire early. This is the total collapse. There are 6 sectors, 5 of which are positive growth, and 1 is stable income. Choose a satellite that matches your target. Adjust it appropriately to surround a solid core, and be patient in the noise. I see that the biggest mistake investors make is not choosing the wrong sector, but panicking out of the right sector prematurely. which is why discipline is more important than talent in this game. Stick to your argument, keep adding capital, and remember to keep investing simple.